Hello, good afternoon, everyone. This is Kathryn Rooney Vera, Chief Market Strategist at StoneX. Let me start with the most important point. The global economy didn't enter the shock from a position of weakness. The soft landing, as I saw it, was in fact holding. Going into this event, the US real GDP growth was running last year at 2.2%. Unemployment was 4.3%, moving only gradually higher, which is a historical anomaly. Productivity was improving. Last year was 2.2%. For fourth quarter 2025 was 2.8%. And core PCE inflation was still elevated, but within that range of what we view as comfortable for the Fed of 2.5 to 3%. In other words, in my view, the baseline macro regime was stable. This is important context going into the shock that we're seeing. So what we're dealing with now is an exogenous energy and supply shock testing that baseline. This is how we're seeing it. The key variable from my view, from my perspective, is the duration of the closure of the Strait of Hormuz. That determines the outcome. It's not the headline escalation in the Middle East. It's not bombs, it's tankers. It's the duration of this disruption in oil flows through the Strait of Hormuz. And let me explain why. The Strait of Hormuz, as probably many of you know, normally handles roughly 21 million barrels per day of petroleum flows. But I'll add something to the conversation that few are talking about, and that is not just energy, not just oil, but it's fertilizer flows. And a third of fertilizer flows, a third of urea goes through the Strait of Hormuz. So that means a lot for food prices because right now we're entering the farming season, and that's going to impact food prices. So this is one of the most important, second most important choke points in the world. Under normal conditions, we're talking about on average 200 vessels through the Strait of Hormuz, but right now that's collapsed to zero. So this turns a geopolitical headline into a physical flow shock. And that matters for inflation primarily as the first point of entry. Of course, it affects economics afterward, but first entry point is inflation. So when we look at the presentation that I'm showing here, we have inflationary pressures, we have disinflationary pressures, and we have the swing factors, as I call them. And really, what the major impact here, I think, is going to be on is energy, fuel and freight costs, which will pass through directly to CPI, and then later to core PCE. We have tariffs and supply frictions, and we have core inflation that's still above 3%, going on the fifth consecutive year for the Federal Reserve, which is already facing a credibility shock with regard to its dual mandate. On the disinflationary forces, we have growth momentum, which was already slowing. We saw economic growth slower in 4Q, probably going to reignite in first Q given base effects, favorable base effects. Labor market has been cooling, and we have productivity gains. All of those things are good for disinflation. The swing factor is something more long term, in my view, with regard to productivity. AI has been this arms race for capital investment to AI, and that's going to pay off eventually, but 2026 is not the year it's going to pay off. So the productivity gains we've seen, in my opinion, do not have anything to do as yet with AI because whole-scale adoption is simply not there. The swing factor that I see right now is duration of the shock. This is something I'm going to go through more in depth, but the pass-through of the energy shock will face margin pressure and prices could very well rise. This matters because energy markets do not respond only to productivity losses, production losses. They respond to logistic failures, and that's what we're seeing right now. Oil obviously can exist underground in storage tanks, but it can't move through pipelines, ports, and shipping lanes. The effective supply available to the global economy then fails if it can't move through the strait. So this is exactly the dynamic the markets are now starting to price. So this brings us to what many are looking at, and I'll highlight a colleague in the industry who has calculated the amount of days. But shipping disruptions last only a few days. Markets can absorb the shock, but if it lasts for longer than storage capacity allows, then we get production destruction. Right now, we've already seen freight rates spike, we've seen insurance premiums spike, and prices adding to a temporary geopolitical risk premium. That's already happening. But right now, as you can see in this visual, given to us or done by a JP Morgan's eminent research team, the normal range of transit is 200 vessels crossing through the Strait of Hormuz. We're down to zero. Many of you are probably already aware of that. And that in and of itself is meaningful for the near term. So the amount of days is important. We see Iraq and Kuwait probably the shortest term in terms of storage, and that's going to have an important ripple effect on the price of oil as production must need be cut. So shipping disruptions last only a few days. Markets can absorb the shock. If it lasts for longer than 2 weeks, in our view, this is going to be a more meaningful macro structural impediment. So storage begins to fill, production is cut, oil prices are sustainably higher, and we see the spillover not just through margin pressure, but also through food prices, and that eventually hits core PC. So at this point, the system transitions from a logistics shock to a true supply destruction, and this is what we're looking at now. So what we've looked at is estimates suggest that flows remain blocked long enough. As much as 20 million barrels per day of production, which is what goes through the Strait of Hormuz, will be at risk. And historically, every million barrels removed from supply can add incrementally to the price of oil. So that's why duration matters more than initial price spike, and that's why duration matters more than headlines. So these are the two scenarios that we at StoneX Strategy and Research are envisioning. Scenario one is a temporary price shock, flows resume, insurance markets stabilize, freight costs normalize, and oil prices eventually revert back to the $70 to $80 range from the triple digit range, which we currently are in. In that environment, inflation rises briefly, but it fades within a couple of months. We've seen this story before. Thank goodness we have history to educate us, and we've seen historical price shocks from energy dislocations in the energy market. What does this mean for the Fed? The Fed rate cuts are delayed. It does not cancel them, but it really does depend ultimately. The key variable here is duration of the closure. What we have at StoneX worked out in terms of the impact on both CPI and inflation is as such. You can see in the presentation here, there's a range of a magnitude range that will affect both CPI and GDP if we get what we modeled was a $50 price shock. So $70 to $120. So CPI, this is not core PC, this is CPI. CPI peak range could be 2 full percentage points. So instead of 4%, we're at 6. Peak the lowest impact could be 60 basis points. And then on the real GDP front, we could see a market slowdown. So this is a very real threat. And of course, without saying the term, I'm sure everyone agrees this is a massive stagflationary impulse. I think it's important to remember where we came in, and that's why I started this conversation at the beginning, which was that the US was growing at a very good pace, at trend and above potential. And that's important because the impact could be meaningful, but it may not throw the US into recession. It all depends on the duration of closure. So the Fed delays cuts, but does not cancel them in the event of a temporary closure of the Strait of Hormuz and eventual opening. I think equity markets rotate towards energy and defense sectors, which we're already seeing, and credit spreads widen significantly before compressing again. So in the meantime, what happens with the Fed? If we look at history, the Fed over the past 4 decades, 5 decades, doesn't have the best track record. So we should expect, given this energy shock that the Fed holds, we should not expect any rate cuts this year. If this turns out to be a temporary disruption and a transit issue more than a production destruction concern, then the Fed might likely will continue to cut rates at the end of the year. If this, as it seems to be the case, as of standing today at 4:30 on March 9th, if it seems like it's going to be a more prolonged issue, the Fed doesn't cut this year. And I think, in fact, there's a real risk that given history, if the Fed hasn't learned its lesson, that it could hike. So that's scenario two is prolonged supply disruption. One of the things that we're looking very closely at is productivity as the swing variable. Um, Productivity has been phenomenal. The question is, does it continue? And does this AI arms race and massive investment turn into upside for productivity? Productivity, of course, means that we can handle higher inflation. So when you have unit labor costs um, uh, counteracted by productivity levels, then you can absorb more inflation. So I think this is going to be the signal that changes everything. If productivity stays above 2%, in my view, according to our analysis, we can handle wages at about a 4%, which is where we're currently at. Um, what does this mean for our clients at StoneX? A lot of our clients are agricultural producers. So this feeds directly into them. Energy shocks can propagate through to the economy very quickly. Higher oil prices feed directly into gasoline and diesel. Diesel feeds into freight costs, agriculture, shipping, industrial transport. This has a lot of tentacles, and I think we're all aware of that. But the estimates we've modeled have shown the shock of the magnitude could be significant. We're talking between 60 basis points and 200 basis points, as I said, to headline CPI, and it could affect the real GDP modestly in the near term. So the immediate macro impulse is, in fact, stagflationary. But one of the things that I wanted to highlight on this call is the importance of fertilizer and agriculture, which really isn't getting enough attention. 1/3 of global exported urea transits through the Strait of Hormuz. We know that 1/5 of oil transits through there, and about 18%, 20% of liquefied natural gas does as well. But fertilizer is not getting a lot of attention. And this is important because what we're seeing is the planting season is starting right now in North America. March and April, if we get a disruption in fertilizer shipments and delivery, we're not talking about a delayed season. We're talking about a lost season. And that will have dramatic implications for food prices down the line. Not to mention that we also have one of the two major um, gasoline, vehicle gasoline consumption periods coming up. That's early May, June, when the summer kicks off here in North America. And the second one, of course, being midwinter. But this is going to cause a major issue for travelers early in the season. So gasoline demand in the US, as we all know, is highly seasonal, and this is going to affect that. Consumption typically rises in May and June and peaks during the summer driving season. So retail gasoline prices are already on the upside. This will affect, in my view, midterm elections. People care. Affordability is already an issue. Retail gas prices respond to crude and wholesale fuel markets with pretty directly, minimal lags. But we're talking about days or weeks rather than months. And as I've said, we've already seen approximately 35 cents on a national average increase on the price of the pump. So the reason the current disruption matters for May is precisely because of the summer season. So every spring, refiners shift from winter fuel blends to lower volatility summer blends, and that's what we're facing right now. In terms of the securities markets, this is what we're seeing, as you can see here in scenario A versus scenario B. Scenario A, we call it the fork in the road. Scenario A is the temporary spike. Scenario B is the supply disruption. As days go on, it's looking increasingly like we're facing scenario B. We, of course, have here in the US, we have our reserve duration of reserves, but that's pretty low. And the impact on that is historically low as well. So we cannot rely on the strategic oil reserves here in the US. So Let's look at securities. Really, what we've seen is historically investors buying government bonds, yields fall, curve bull steepens. In this initial reaction, it was the opposite. What we were seeing is the risk-free asset selling off, and that was because inflation was trumping the growth shock. We saw 10-year Treasury yields move higher, and that's precisely because of the inflation issue really overwhelming the threat to growth. So higher oil prices affect inflation expectations. What we're seeing, interestingly, is inflation expectations at the short end surge and the back end dropping. So that tells us a lot. Um, and there's a real risk here of a change in what we saw coming in. So we're looking very clearly, very closely at inflation break-evens. Break-evens have been drifting higher, markedly so. So the move has been modest so far with regard to the market reaction, but the direction in our view reflects the market pricing higher near-term inflation rather than recession risk. And unequivocally so, even if this is by some miracle resolved in the near term, the impact near term on inflation will be to the upside. We shouldn't expect this for the month of February, but for the month of March, we will see some inflationary impulses to the CPI prints. So we've seen the Treasury curve steepening, long yields rising faster than short-term yields. What I looked at here is where we sit now versus history. And the markets are more overvalued than we have seen in previous times. So this is something to be aware of. And what we're looking at going forward in terms of how to analyze whether this is going to be scenario A or scenario B. Of course, Hormuz traffic, ship crossings, do flows resume? War risk insurance, does the Trump administration's promise of guarantees for insurance, naval force presence in the strait to, guide these tankers safely through the straits, does that pay off and get the flow going? That's to be seen. Product inventories in terms of refinery, how many days can we cover before there's some major production destruction? And then on the market side, inflation expectations and credit spread widening. So those are pretty much what we're most looking at in terms of how to roughly define this. The soft landing held, just to sum things up, and then I'll go over China and gold, and then I'll take some questions. But in terms of what we're summing up here, the soft landing held before this. Some guys were talking stagflation. We were never in that camp. I think this is an enormous, unequivocal stagflationary impulse. Prior to this event, in my view, what we were seeing was a very benevolent world where we had economic growth above trend, above potential, with a labor market that was softening but not breaking. The consumer was not broken. Now, this situation with Iran presents a fork in the road. One path is temporary rise in risk premium and then a reversion to the mean. The other is a sustained supply constraint and I would say production destruction. In this environment right now, the Fed doesn't cut for the foreseeable future. Core PCE runs the risk of rising above 3%. Fed credibility is at stake, and productivity is a swing variable. If it holds near 2% to the upside, and the scenario resolves itself, the regime works. If it slips, everything reprices. Productivity is going to be the key variable going forward. And the thing to really figure out here is with regard to food prices, because fertilizer is something that we really haven't been looking at, or very few analysts have been looking at. So this is what we've been analyzing over the course of recent history. We saw energy shocks in 1979, 1990, 2008, 2022, and now we have in 2026. And these are the moves that we saw over history. So it's worthwhile. Of course, history is not a predictor, but it's certainly worthwhile to look at the correlation between oil and gold and markets and to see what has come out of it. We've seen many instances of recession varying in strength. But it doesn't necessitate that we are entering a recessionary environment. Finally, to look at a couple other countries and regions that are more vulnerable than others, we did some analysis on China and other countries that are most vulnerable, and China is one of them, and then other energy importers are as well. So the U.S. stands to, in some aspects, benefit because it's a net energy exporter, as I mentioned here in this visual. And U.S. is the world's largest oil producer. We're talking a fifth of global output. It's the largest LNG exporter globally. And the US can rebalance global supply in terms of absorbing market share. And that said, the SPR, as I mentioned earlier, is depleted, rig count is declining, and storage is low. With regard to LATAM, one of the primary beneficiaries of this is Brazil. I think we've seen that reflected in market pricing, similar with Argentina, but the importers are going to get hit pretty substantially. And you can see a fertilizer, ag, we've mentioned this before, and shipping and freight as well. So I'm going to end it there, a nice half an hour, and I'm happy to take questions. And if there are none, we are available at StoneX to coordinate calls with clients. Please reach out to your sales representative. Thank you. And Julia, with that, we'll see if there's any questions here, and if not, we will close the meeting.
Hey, Kathryn, can you see the questions? If you can't see the client's questions, I can read one for you. I'm not able to hear you. I think you're on mute.
I see one question, Julia, and that's with regard to fertilizers. And with regard to that, I'm going to recommend that you reach out directly to our fabulous team of analysts that we have at StoneX, which covers commodities, everything from fertilizers to corn to wheat. So, Julia, I will recommend that the client asking for specifics on fertilizers reach out to our commodity team, which covers, we have an analyst that specifically covers fertilizers. Julia, if there's any other questions, I do not see them, so I'd be happy to answer them.
Yeah, we have two more questions. Can you go over the gold going forward again, please?
Oh, absolutely. And can correlation between
Yeah,
oil
exactly.
shock and gold also? Oh yeah, okay. These are great questions. Now I'm just seeing them. Thank you very much. So yeah, I like gold. I think gold makes sense. Our gold analyst, Rona O'Connell, agrees. I see there's another question on silver. We are less bullish on silver. We think it's overbought. And I would refer you to Rona O'Connell, who specifically is our precious metals chief analyst on this. But I do think that gold benefits from many things. One, I would say, is a crisis in fiat money. Two is inflation. Three is uncertainty. And also not just central bank purchases of gold diversifying away from US treasuries, but also real investors, retail investors that are increasingly buying gold as a hedge, not just to inflation, but to uncertainty and this lack of faith in fiat money. So I like gold. I think it goes higher. To answer your correlation between oil shock and gold, I'm going to put my chart up again here. I think silver, well, I think, and also our economist thinks that silver is has a vulnerability to a downside and that it's overbought at these levels. Does growing Fed's money supply influence inflation? So a lot of what the Fed has done is influenced inflation. The Fed has maintained or has in the past decade maintained rates artificially low for an extended period of time whilst buying assets. So what that has done, it has taken financial assets markedly higher. And what that in turn does is create the wealth effect. So right now we are benefiting from the fruits of an overly ambitious Fed over the past decade. So probably the Fed is unable realistically to cut rates because we have to make up for errors of the past. Let's put it that way. And I think that despite the president desiring, understandably so, because the US interest payments have now doubled versus as a percent of GDP over the past few years, despite the president's desire to reduce the amount of interest costs that the country pays, it's going to be very difficult for Kevin Warsh, if in fact he is not approved as the next Fed chair, to cut rates. We do not expect any rate cuts in the first half of this year. The best scenario that we can get is 4Q of this year, the back end of this year, and that's only under the situation where one, either the Strait of Hormuz normalizes and allows transit through, and I'm talking over the next 2 weeks, or two, we see a massive surge in unemployment. Okay, so those are the only two situations where we realistically see the Fed cutting this year. Shipping costs are going to be high for a sustained period of time, in my view. I would guess over. I'm answering a few questions here. I suspect that they're going to remain high for a sustained period of time because, without being a geopolitics expert, this seems like a situation that is difficult to resolve in the near term. I know that the president said, I'm answering one of these questions here, Julia, the war could end soon, within 4 to 5 weeks. That's not enough. So great that the war ends in 4 to 5 weeks. But what I think is important for we private investors to realize is that once storage capacity reaches its maximum, production has to be cut. So we can quantify, and this is thanks to Natasha Kaneva, who did this analysis. She quantified how many days each GCC country has of storage capacity. Once they reach that capacity, if the Strait of Hormuz remains closed, once they reach that capacity, they have to cut production. Where are they going to put it? So if this ends in 4 to 5 weeks, the damage is done. And we are facing a situation where we have stagflation. And that means sustained high oil prices for 2026 and some amount of shock to growth. And I showed that fan chart before. We're talking between 60 basis points to 1 percentage point impact on growth here in the United States. DXY, the question with regard to strength of the dollar, is that the dollar still remains the sovereign reserve currency of the world and still remains the safe haven. So the dollar probably strengthens. How much worse the job report could get? The last one wasn't very encouraging, and that's a very good point. But the truth is, when you look over history, 4.6% unemployment is not too bad. And if you're asking me, the NAIRU, which is the non-accelerating inflation rate of unemployment, being at 4.9%, we're still below that. So I'm not overly concerned. I think that the Fed kept rates so long for such an extended period of time that it caused an overheating in the labor market. And now we're taking that back. And that's important. Why? Because out of the 3% core PC, 1.8 percentage points, almost 2 full percentage points of that 3%, come from the consumption of services. What drives the consumption of services? Wages. So if you get a softening, especially everyone, a gradual softening, which, as I mentioned at the outset, is a historical anomaly. Usually unemployment rates, when they start to rise, they surge. But in this case, we have this incredible benefit of an unemployment of a labor market that was too hot and that slowly the air started to deflate. That's, in my view, a soft landing. That's what we were facing before the shock. Um, so I think that the jobs report um, was not encouraging. I do not think that the risk of recession is higher than 30%, even right now. And that has increased from 20%. So if you're asking me my percentage probability on recession, that would be it. And here, Julie, I'm looking at several more questions, and I'm happy to answer all of them. Um, So the question with regard to how long could the US tolerate this conflict, I'm not sure that it's a question of changing things on the dime. I think already it's not tolerable, but there is no fast solution to this that I can foresee. I think the economic costs right now will already be felt. The duration of the closure just exacerbates them. So right now we're talking about logistics, okay? If this is not reopened, this meaning the Strait of Hormuz, if the 200 vessels per day and the 20 million barrels per day are not allowed to flow through the Strait of Hormuz, then we are going to see a reduction in production, which means that supply and demand get distorted. So I think that we have a very clear number of days here. If this, in fact, does take 3 to 4 weeks, let's say the reserves that we have in the U.S. help out somewhat, maximum that gets us 3 weeks. So if it takes longer than 3 weeks, I see some serious implications with regard to inflation, and subsequent to inflation is growth, because it always hits inflation first. With regard to questions specific to specific commodities, it is with great pleasure that I direct you to our team of commodity analysts, specifically Arlen Suderman and his fantastic team, who can direct any price of questions with regard to cotton and oil and corn. Um, they will happily answer those questions. With regard to the question facing midterm elections, let's be clear here. Historically, every single incumbent party loses in the midterm elections. Okay, so the Republicans were going to lose seats regardless. In fact, coming into this shock, my view was that the Republicans were going to lose at least one branch of Congress. So there is a political impetus to resolve this because people hate paying a ton of money at the pump. So there is a political reason to get things flowing through the Strait of Hormuz. The constraint is how to do this. Um, Thank you for mentioning Natasha. I think she's fabulous, and yes, I agree. Her paper was fantastic, and that's why I'm specifically citing her fantastic work. Private investment funds, there are some questions on private investment. I agree. I think we need to be careful with regard to high yield bonds. That would be my caution zone. I think we have to be careful with very low quality paper at this point, because I think there will be a spillover, especially if the Fed has to keep rates high when everyone was banking on additional downside. And with that, Julia, I think I'm going to close this conference. And we've taken note of your questions. Thank you very much for all of them. And please do reach out directly to your sales coverage. We are here to help you. And if you would like a call directly with me, I'm happy to take that. So thank you all very much for your time. Goodbye.